Welcome back to Investing Talk Podcast.
Today we're looking at SERV Robotics.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Let's do it.
To really understand SERV Robotics, you have to realize we're looking at a company at a really critical early stage inflection point.
An inflection point.
Yeah. The whole thesis here rests on understanding that their focus right now is just on one thing. Operational scale, not profit.
Okay, and when we say scale, let's ground this in reality for a second. The revenue base is, it's tiny.
It is.
Full year 2024 revenue was just $1.8 million. So the question is, why are we even talking about a company with a top line that small?
Because that 1.8 million, that's a lagging indicator.
Yeah.
In these kinds of robotics or SaaS plays, you have to look at the leading indicators of future growth.
Okay.
And SERV's Q1 2025 metrics. They were pretty stunning. They point directly at a major acceleration.
All right, so let's unpack those. What are the numbers that tell the real story here?
Okay, so there are two figures that are absolutely essential. First, the number of daily active robots. That increased a massive 87% year over year.
87%. So they jumped from what, around 39 units to 73?
Exactly, from 39 to 73. And second, maybe even more important, is daily supply hours.
Which is how much work they're actually doing.
Precisely. That surged 116% year over year. It went from 300 hours to almost 650.
Wow, that 116% jump. That's what validates the whole concept. They're not just putting robots on the street. Those robots are actually working, generating data, getting smarter.
Right. It's exponential operational growth. But, that kind of scaling, it comes at a cost.
A big one. The Q1 net loss was around $13.2 million, and that's the number that scares people.
It does, but you have to frame it correctly. This isn't a margin failure. This unprofitability is a strategically justified cost of deployment and R&D.
So they're spending money now to grab market share, to perfect the tech before competitors can, flood the zone. It's a classic playbook.
It's the classic scaling playbook. You're building the infrastructure to go after a massive market. The total addressable market for last-mile delivery is estimated at over $50 billion.
$50 billion.
So if you're building for that, you accept a $13 million quarterly loss as the tuition fee to get there.
And I think that's a key distinction. Some companies lose money because their unit costs are just too high. That's not what's happening here.
No, not at all. This is a revenue scaling challenge. They're buying future capacity. Imagine building a huge factory for $100 million before you have your first customer. The costs look insane compared to zero revenue.
But the potential margin on every unit you eventually produce is huge.
Exactly. Once that tiny revenue base grows, it absorbs those fixed costs fast, and margins just explode.
Okay, so that completely shifts the conversation. This isn't about survival risk, it's about momentum. Which brings us to, I think, the most powerful part of this story, the balance sheet. Because usually a company burning $13 million a quarter, we'd be asking if they're going to make it.
And that existential risk for SERV Robotics has basically been eliminated. Their financial health is what you'd call a fortress balance sheet.
Just break that down. What did it look like?
So as of June 30th, 2025, the company was sitting on $183.3 million in liquid assets. Cash and short-term securities.
Which is already a lot of breathing room.
A ton. But then they got a turbocharge.
The big one, the capital raise.
The big one. A $100 million registered direct offering in October. And what's so important here isn't just the amount, it's the conviction.
Who was buying in?
It was fully subscribed by large, sophisticated institutional investors at $16 a share. That's a vote of confidence you just don't get from retail.
So $183 million plus another $100 million. What's the war chest look like now?
Post-offering, they're holding approximately $280 million in cash.
Okay, so let's compare that to their burn. In Q1, they burned, about $9.5 million in cash from operations?
That's right, about $9.5 million.
So let's do the math. $280 million divided by 9.5.
You're looking at over 29 quarters of financial runway.
29 quarters, that's more than 7 years at that burn rate, though you'd expect the burn to change. It's effectively 2 to 3 years of solid runway.
It's an absolute game changer. It means management can focus 100% on unit economics, on growth, on market share, without constantly looking over their shoulder for the next capital raise.
That time, that luxury is invaluable.
It really is. And on top of that, they have almost no debt. Total liabilities were just over $7 million. So there is zero financial leverage risk. This balance sheet lets them be hyper-aggressive.
So they have the capital to play the long game. Now let's talk about what they're actually building. You need a competitive advantage, a moat. What's SERV building that another company can't just copy?
The primary moat is data, specifically their autonomous delivery network and all the operational data it generates.
And this isn't theoretical.
Not at all.
Right.
It's happening right now. Every single delivery with those 73 robots is generating crucial, real-time geospatial data, machine learning data, high-res maps.
Okay, but give me a concrete example. What does a SERV robot know that a brand new robot on the street tomorrow wouldn't?
Hyperlocal knowledge. It knows the exact width of a specific sidewalk, the location of a pothole that's been there for months, the height of every curb, the traffic patterns at 5 p.m. on a Tuesday.
Right.
A competitor can build a robot they can't instantly replicate years of that kind of accumulated localized data. That creates a network effect.
The more they deliver, the smarter the network gets, the harder it is for anyone to catch up. What about the regulatory side? That must be a huge barrier.
It's the secondary moat, and it's huge. SERV has already spent the time and money to get operating permits in key places like San Francisco and Los Angeles.
And each one of those permits is basically a wall.
A durable regulatory barrier to entry. Because cities are cautious. They might cap the total number of operators. By being one of the first, they've become the trusted partner. It's exponentially harder for the fifth or sixth company to get that same approval.
Got it. So they're building a wall with government partnerships. What's the last layer of defense?
The tertiary moat is just basic customer lock-in. When a restaurant integrates SERV's API into their point-of-sale system, they've built their whole workflow around it.
Switching costs are high.
Moderate to high, yeah. You don't just rip out an integrated system because a competitor offers you a 10% discount. It's too painful. That creates a sticky customer base.
Okay, this is where it gets really interesting. Connecting the operations to the market sentiment. Let's go back to that $100 million raise. It's not just the cash. The fact that institutional investors subscribed at $16 a share. That's a huge signal.
It's a massive signal. These big funds, they do extensive due diligence. They looked at the 87% growth. They saw the data moat, and they decided that $16 was an attractive price. It's powerful third-party validation.
And from a technical perspective, that $16 price, it becomes something of an anchor for the stock chart, doesn't it?
Absolutely. It acts as an implied technical support level. The institutions that put in $100 million have a vested interest in supporting the stock around that level. It creates a sort of psychological floor.
And we don't have to wait years to see if they were right. There's a catalyst coming up.
That's right. The Q3 earnings announcement, expected on November 12th, the market is going to be laser-focused on one thing.
More growth in those key metrics.
Continued acceleration in active robots and supply hours. If they post another quarter of 80+% growth, it validates that whole institutional thesis.
Okay, we have to be objective, though. A pre-profit company scaling this aggressively. There are always risks, even with all that cash. What's the bear case?
There are two major risks for sure. The first is regulatory headwinds.
A city could just change its mind.
Exactly. A city could impose stricter limits, cap the number of robots, and constrain their growth overnight.
So how do they mitigate that?
Through that secondary moat we talked about. Their existing permits and relationships give them a huge first-mover advantage. They're already inside the regulatory tent, helping to shape the rules.
Okay. And what's the second big risk?
Unit economics uncertainty. This is the big unknown.
Right.
The company hasn't disclosed key metrics like revenue per robot per day or the payback period on a new robot. If those economics are fundamentally flawed, then they're just scaling losses.
But this is where that massive cash position comes back in as the final counter argument.
It's the ultimate counter. That $280+ million balance gives them 2 to 3 years, a lifetime in this space, to prove out the model. They can iterate, optimize, and perfect it without the market breathing down their neck.
So when you put it all together,
You have a high-conviction, early-stage growth story at a clear inflection point. The risk-reward, I think, is highly asymmetric to the upside because of that operational momentum and the fortress balance sheet.
and there's one more layer here, a potential speculative catalyst, M&A. When you build these assets, the cash, the fleet, the data, and especially those regulatory permits, you become an immediate target.
That's the final piece of the puzzle.
Right.
A major player like Amazon or Uber or DoorDash. They're all desperate to accelerate their autonomous delivery game.
And SERV offers a way to buy, what, 5 years of progress instantly?
Instantly. They can acquire the tech, the data, and the crucial city permits without having to fight all those battles from scratch. It makes them a very attractive takeout candidate.
A potential takeout.
Yeah.
That's another layer of support to this story. Definitely something for you to mull over as you watch this space evolve.
Indeed. It's a compelling story of safety, scale, and capital.
If you enjoyed this analysis, make sure you subscribe to the show for our next one. We bring you the most critical insights right from the core of the market data.